Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, last week we had a pre-recorded show actually detailing an option structure that you've enacted for the portfolio. And it's very interesting now to have you back live in the studio to chat about it, because we've seen US markets, scurry up to record highs, and I wonder how you're feeling about the structure that you put in place, although it is, I suppose, a longer dated structure.
Yes, that's right. So last week's show was pre-recorded about 2 weeks back, where we spoke about that structure on the S&P 500. Now, the slide that's up on the screen at the moment is a replication of what we showed on that previous show. Effectively, you can see the chart of the S&P 500 over there, and then overlaid with that, we've then got the options payoff of the structure that I've done for the April 21st expiry. And we did this on our offshore account because we can do that now, given that we're trading offshore markets as well. And I like the structure. I mean, it makes up to $1,260 at its peak. And that is if we see the S&P 500 pulling back to a level of 2280. Anywhere between 2280 and 2180, it makes its maximum profit. And then only down below 2100, we'd start to run into trouble with that structure. Anything above 2350, we only lose our premium, which is $140. So the risk to reward ratio on this trade is very favorable for us. So how am I feeling about it? Well, I'm feeling fine. I think that I know that if the market continues to rise, the maximum that we can lose here is $140. I'm not worried about that at all. If I look at this chart of the S&P 500 and what it's done recently, I mean, I think that move that we saw up last week, I think it was Wednesday, we saw a big move to the upside, and you can actually see there's a little gap in the chart there that I'm pointing out now. Yeah. Now, I'm wondering whether that possibly was an exhaustion gap in this S&P 500 rally that we've seen. It's really gone almost vertical over the last month or so, and that gap up could possibly be an exhaustion gap. We also now get an RSI sell signal where you've had your RSI above 70, and then it's begun to cross down below 70 now. So you put all of that in place, and I think at the very best, I would expect that the S&P 500 now probably consolidates sideways, and at the worst, maybe it starts to come down from these levels. So I feel comfortable. This structure will make us money below 2350, and I think that it's fair probability that we'll see that at some stage. We've got until the 21st of April for this structure to work out. If it doesn't, we lose our premium of $140. It's less than 1% of the capital that we've got to trade on our offshore account. So I'm not particularly bothered about that. I'm quite comfortable where we sit right now. Indeed.
I mean, this is less of a deliberate decision to go short. It's rather a hedge on the market falling.
Well, that's it. It's effectively, it is a short position, but with limited risk, because a naked short position would mean that if the market continues higher, then we're going to lose money if the market goes higher. However, in this case, because I've done it with a structure with options, we don't continue to lose money indefinitely if the market rises, but we do make money if the market goes lower.
All right, so that's the option structure. 21st of April, I guess, is the date that we've got to watch. What about some of the recent trades that you've been in, especially because you were away, and not sure if they worked out that well while you were away?
No, so unfortunately this is the part of the show which, being on live TV and being an honest show and all those good things.
And an honest chap.
An honest chap, so we have to come in and every now and again and report the bad news. And unfortunately this week I've got two particularly trades that have not worked out for us, and they were both stopped out now while I was away on leave. So the first one is the trade in BHP Billiton, which we did on our offshore account in London. And if we have a look at why I did that trade, basically I identified that there was this upward trend that has been intact on the stock since January of last year, and you can see how each time the share price has pulled back to the uptrend line, it's found support. And we went long at £13.60 after the stock had reversed up off of that upward trend. And it looked good for a while, for about 2 weeks, in fact, it was looking good for us. And I was looking for the stock to continue this upward momentum and for it to go and reach the previous high, which was £15. But as happens sometimes in trading, things don't always work out, and the upward trend has actually broken now. And it's broken to the downside. And if I zoom in a little bit more closely, you can see the trade set up now. That really shows us the last 2 months of trade. There you can see the upward trend, which is the long-term trend, the reversal, the perfect reversal up off that trend line, the rally, but the rally faltered. And it's come and it's broken down below that rising trend now. And if you look at the trading action in the last couple of days, it almost looks to me like we're now getting a throwback to the underside of that previous rising trend. It's reversed back down again from the underneath of that trend line. It's also reversing down off the underside of the 50-day moving average over there. So all in all, right now, this setup's not actually looking too fantastic anymore. But as with trading, it's a probabilities game that we play. We go in with the best expectations and doing the best analysis that we can. But we always do put a stop loss in place in order to protect our risk in the event that I'm wrong. And I am wrong quite often, in fact, which is fine in trading, and you're going to get things wrong sometimes. The key is that when you're wrong, don't lose a lot of money. And that's where I think we've done okay. We were stopped out here at £13.15. Basically, that implied that the share price took out that previous low from the beginning of February. We were stopped out. It meant that we lost £112 on our offshore account after all costs are taken into consideration. So look, it's not ideal, but as regular viewers will know on this show, part of what has made us successful over the years is the fact that we actually do stick to the stop losses. We make sure that when we're wrong, we don't lose a lot of money. I mean, this is just like 1.1% of our offshore trading capital. It's small in the context of things. And the trade doesn't look like it's working. The setup has changed. So we take our cue from the market and act accordingly.
Yeah. And what about the other trade, Weir? Because, I mean, it looks as if, was your stop loss a manual stop loss with BHP Billiton, or was it automatic?
In both cases here, we used automatic stop losses. And the reason being that I was away on holiday, and I don't want to be sitting monitoring the market all the time while I'm on the beach. So I put auto stop losses in on these trades, which worked to our advantage. And our regular viewers will know I don't always employ a manual. I don't always employ an auto stop loss, rather, because I like to manually monitor the stop losses. But in particular with this Weir group, in fact, it worked for us. I think an auto stop loss worked well for us here. If I had employed a manual stop loss, probably we wouldn't have got out with the small loss that we did. And we can look at that now. So the chart of Weir is up on the screen at the moment. You can see there again, it was a case of a rising trend over the last year. It had pulled back into the upward trend. And what I said at that stage was that the stock had been trading in this tight range between about £19.70 up to £20.50, and the break out the bottom of that range and then the reversal back up into the range suggested to me that the likelihood was that we would probably then see a follow-through out the other side of the range. And that's typically what you would see in a situation like this, where you get a false break to the downside. In any case, it didn't work out. And again, we went long at with 170 CFDs at £19.79. The stop loss was below that reversal low in early February, and that was at £19.20. It was stopped out. And you can see there was a day there where the stock was down about 9% on the day. And fortunately, because we had an auto stop loss in place, it got us out at our stop loss price of £19.20. And that meant that we lost almost £114 on this trade. So again, just over 1% of our offshore trading capital. Not the end of the world. And it could have certainly been worse if the stop loss didn't act up.
Yeah. I mean, this is when you scrape around for silver linings, and that certainly is a real positive, is it?
Correct. We could have lost quite a bit more on this trade if that stop loss had been missed. You can see how the share price dropped very sharply, and it was unfortunate. Look, it has subsequently come back, and it now appears to be sort of testing the underside of this resistance area now. There's a part of me that almost wonders whether it's not actually a short at this level, but I'm not going to be doing that. I'm not typically one that takes the car from fifth gear and slams it into reverse, and I prefer just to go into neutral for a while, and then let's look around. Let's see, maybe there are other trades that we can enact. But in any case, unfortunately, this is another one where we didn't make any money. We lost money. We've lost £114. So it hasn't been a particularly good week for our portfolio. But that's trading. Sometimes that happens, and you always try and keep your losses to a minimum. Yeah.
Well, speaking of being in idle, you're not actually putting in on any new trades for the portfolio, but there are a few charts that I know you'd like to bring up.
Yeah, well, it's something to monitor for the week ahead. These are two charts that I'm going to look at now, which I know we looked at earlier in the year. I think it was on the 10th of January that I pointed out these charts. But I want to revisit them because I think they're very interesting. They are relative charts. So the one that's up on the screen now is a relative of the Resi index versus the all share index, and it's a weekly chart, and it goes all the way back to 2007. So you can see it's a long time that we're talking about here. But the reason I bring this up is because last year we saw the resources shares outperforming the JSE. But on a long-term basis, actually that was just an anomaly. If you look at this chart, this shows you that that long-term trend of underperformance by the resources shares is still very much intact. Notice how that trend line that goes from the peak in 2008 and then it joins all the touch points throughout the downtrend since then, that downtrend still remains intact. And keep in mind, because this is a relative chart, the way we work it out is we take the resources index and divide it by the all-share index, and then we plot those values on a graph. The fact that it's sloping down here means the resources index is underperforming the all-share on a long-term basis.
In fact, I mean, that's what, almost a 10-year bear market for resources shares?
Yeah, on a relative basis.
Yeah.
It's a relative bear market when compared to the all-share index. And the reason I want to point this out is because we've seen a year where the resources shares have done well. And I think typically it's a human condition, I suppose. We attach a lot of weight to recent evidence. So because resources shares have been doing well in the last year, we think that they're going to continue to do well. But if you look at this chart, it says to you maybe that you need to be a little bit circumspect in terms of that thinking. And notice that the relative chart actually appears right now to be rejecting this downtrend resistance. In other words, it looks almost to me like we're about to start another leg of underperformance by the resources shares relative to the all-share index. Okay, and if you take the fact that our BHP Billiton chart has broken that long-term uptrend, maybe that's just a warning. So I think be careful of just thinking that resources just continue to outperform forever and ever, because this chart is telling you be very careful of that. Maybe we're going to see some sector rotation away from the resources. And to that end, I now want to look at the FINDI sector relative to the all-share index. So the FINDI, it's basically the FINDI 30 index. These are all your big domestic stocks. There's no resources in here, so it's all your big industrials and your big financial stocks. And we know that on a longer-term basis, the FINDI area of the market, the domestic stocks, have been the outperforming area on the JSE over the last number of years. However, last year, in 2016, that was not the case.
Yeah.
The FINDI sector underperformed the rest of the market, and you can see it quite clearly there in the end of the chart. That was 2016 and where that sector underperformed. But on a long-term basis, that to me is just a blip in the long-term outperformance trend by FINDI stocks. And in fact, from a technical point of view, it looks like we've got a falling wedge pattern over there that's beginning to break to the upside. And if that's the case, then that suggests to me that we're now about to start to see, in fact, we've already begun to see the beginning of a new outperformance trend from the FINDI sector. So maybe keep in mind that we might see some sector rotation away from the resources into the FINDI stocks.
Yeah, and those presumably are the stocks in that you'd be looking to trade?
Ideally, because that looks as if it's the area of the market that's going to have the best momentum on the upside now.
So given the harrowing 2 weeks that you've experienced, what does the portfolio look like?
Right, we've obviously got two components to the portfolio. The South African component has been very idle, and I probably need to be a bit more active here, but we've only done the one trade in MTN this year where we lost a bit of money, so we're down 1.14% in rands. And then if we look at our offshore account, which is where we've been a lot more active, there you can see the recent losses that we've taken on BHP Billiton and Weir Group. And then we've got our option structure on the S&P 500 where we've paid away our premium of $140. So once we've taken all of this into account, unfortunately, that offshore account is also now slightly in the red. It's only 0.4% in the negative, so it's not much. But unfortunately, we were up nearly 3% for the year to date last time I was here, and we've given back all those profits now. Yeah. Be that as it may, it's not the end of the world. We've still got the rest of the year to recoup it. So let's keep at it.
Yeah, let's keep our spirits up. Garth, just a quick reminder that people can subscribe to a weekly alert.
Yes, we've got a weekly free email that we send out. So if anyone would like to get a heads up on what's coming up on the show each week, go to traderscorner.co.za and you'll see a link in the middle of the page there that says free weekly email. Sign up. It's quick and easy to do, and you'll receive an email at lunchtime every Tuesday telling you what's coming up on the show for the week ahead.
Great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.